Hi, welcome to Money 9. I'm Karthik Malhotra, and on the show today, Kirtan Shah joins us. Kirtan Shah is the co-founder and CEO of SRE Wealth. Kirtan joins us to tell us why the fixation with fixed deposits is perhaps not the best thing to have. Kirtan is also going to try and explain to us that in the absence of fixed deposits, even being able to beat inflation, what are the options available to us? Hi, Ketan. Thank you so much for being with us here on Money 9. First up, we all know right now that fixed deposits are not lucrative because the interest rates being offered are even unable to beat inflation. Are there any other risks involved in these instruments?
Karthik, thank you so much for inviting me on the show. So, Karthik, like you rightly said in your introductory remark, I think it's a misconception that fixed income or fixed deposit investing is risk free. But the point that everybody misses, in my opinion, is that risk for everybody is only loss of capital or interest not being paid back, which is termed as default risk, right? But fixed
Right.
income does not only have default risk; there are multiple other risks that people, while doing fixed deposits, don't understand, in my opinion. I think first is the prime reason of why do you want to do investing. So you want to do investing because you want to beat inflation. In most cases, while you invest in fixed income, right, post tax, so if you invest in a fixed deposit which pays you 6%, and if you are in the 30% tax bracket, what you actually get in hand is only 4.2. With that 4.2, are you able to beat inflation? My understanding is no. And tax inefficiency is also a risk which we don't look at. Another risk is illiquidity risk. What I mean by that is, let's say, for example, today, if you invest in a fixed deposit for 3 years, right, what might happen is you might, for some reason, might need this money before 3 years. If you end up going to the bank trying to withdraw this money before 3 years, the bank typically charges you a pre-maturity or pre-withdrawal penalty, which is roughly 1% of the interest, which is also a risk, is because while you are trying to take your money back, you are charged a penalty. And also something that I typically see investors miss out on is something called as interest rate risk. What is that? Today, imagine if you invest in a fixed deposit with such low interest rates for 5 years, you end up actually locking yourself in for these lower interest rates for 5 years. So tomorrow when interest rates in the market goes up, the same bank for the new fixed deposit pays you higher interest rate, but you are still locked with the lower, smaller interest rate for 5 years. This is also a risk which a lot of us don't understand. So I think we should get out of this fixation that risk in fixed deposit is only losing the capital or not getting interest paid back. All of these other risks are as important as that, which most of us neglect or ignore, Karthik.
Right. So clearly coming out, Keaton, you are not a proponent of fixed deposits at all with so many risks that you outlined for us. I think people who've parked their money in fixed deposit would be questioning their own financial prudence. But before we move specifically, into the subject of whether fixed deposits are right or wrong for an investor, I want to understand that as a country, even though the entire market rally is being driven by retail investors, a lot of people who own bank accounts and are not totally initiated into the world of capital markets find mutual funds still to be risky. So if it is not fixed deposits, and if the person is still looking, the investor is still looking at generating wealth, what is the option that is available? Where the risk is not as high as the capital markets, but there are some lucrative returns.
So Karthik, pointing out on the debt mutual fund space that you spoke of, look,
Yeah.
ideally what happens is, in my opinion, that while you invest in one fixed deposit, generally we've seen, let's say a client has 10 lakh rupees. Client does not generally go out and divide that into 5 fixed deposits of 2 lakh rupees. Of course, the underlying theme is that the bank is not going to go bust. But having said that, theoretically, you're taking concentration risk where you are investing the entire 100% of your money with one bank or one corporate deposit or one NBFC, and something happens to that entity tomorrow, there's too much of stake, or rather at stake, which is called as concentration risk. Now, what happens in the debt mutual fund space, because we are talking about that subject, is while you invest that 10 lakh rupees in one fund, right? Invariably, what you've done is you've divided this 10 lakh rupees into 100 different fixed deposits or bonds that fund is typically investing in, right? So that brings down the concentration to a greater extent, in my opinion, is because that 10 lakh rupees, instead of getting invested in one entity, is now getting invested in 100 bonds or 100 entities through that one mutual fund that you've invested in. Also, in my opinion, because I spoke about tax inefficiency while we spoke about banks, right? Here, there is an interesting tax efficiency that comes in while you invest in debt mutual funds. Because the rule says that if you invest more than 3 years in a debt mutual fund, you get something called as indexation advantage. Now, what is indexation advantage in very simple terms is, let's say your debt mutual fund earns the same return that your fixed deposit earns, which is 6%, but you are taxed much lesser. How? So let's say inflation in the same 3-year period where you earned 6% return was 4%, then what net you will pay tax on is only 2%. So 6% mutual fund gave, 4% was inflation. So you will only be taxed on 2%. Now, how much will you be taxed? You'll be taxed 20% on this 2%, which is 0.4, irrespective of whichever tax bracket you are in. So ideally, what you end up paying is you pay only 0.4% tax on 6% that your debt mutual fund has generated, which is 5.6, which turns out to be net, versus 4.2, like I explained to you some time back, in a fixed deposit. Now, that is again a huge advantage of investing in a debt mutual fund. And again, another problem that I spoke of was interest rate risk, where interest rate starts moving up. What happens is, in a debt mutual fund, you have professional money managers who manage this money of yours, and hence they are expected to do a much better job, which probably just lying your investments in a fixed deposit could not have happened. So, which is why I feel that, if you have slight propensity to taking risk, when I say risk, I don't mean that you will lose your money, but because it is in the capital markets, the value may move up and down. Then this investment instrument may serve the purposes, because again, liquidity, you can get your money back in 1 or 2 days of you placing a redemption without losing any penalty or interest to it. So I think it is well placed for investors who are okay with understanding that while you invest in the capital markets, value may keep moving up and down slightly, right? But the risk is not as deep as you think that the capital will get lost.
Right. So, in fact, I was just going to come to the fact that since there is interest rate risk even in investing in debt mutual funds, are bonds not a better instrument which have a fixed coupon rate? Should investors instead be looking at investing in the bond market?
So, of course, Karthik, you can definitely do that. So, my way of looking at fixed income is very simple. I would not ever tell you to put all your money in one particular product, right? So, you should always divide your entire fixed income portfolio into 3 aspects: liquidity, core portfolio, and tactical portfolio, right? What I mean by this in very simple language is that in the liquidity portfolio, try and put money in savings account or liquid funds or mutual funds, so that you can get this money whenever you want. Right. Your core portfolio is typically the portfolio where you want to invest money in products that sync with your risk profile. So let's say if you are somebody who does not want to take any risk, right, then you have post office schemes that you can invest money in. You have a couple of government securities that you can invest money in when there is absolutely no risk and you know your money is going to come back, right? And tactical portfolio is that small percentage of 10-20% of your total investment that you put in, let's say, mutual funds or corporate bonds, right, where you actually will be able to make slightly higher returns, right, so that the overall portfolio is enough to be able to beat inflation in the real world. Now, coming back to your answer, can I invest in bonds directly? Of course, the answer is yes. But what we have to understand is that corporate fixed deposits are different from bonds that we are discussing. So if the question is, can you invest in corporate deposits like, let's say, a Bajaj Finance or HDFC Limited? Of course, you can do that to a certain extent of your portfolio. But if you want to directly invest in bonds which are traded on the stock exchange, right, that's slightly tricky. Is because first, the minimum ticket size of most of these bonds is 10 lakhs and upwards. You can't do a trade below that. And because you you don't know how to go about buying these bonds because they are illiquid, you typically will have to get in touch with a broker who helps you to buy these bonds. So for
Right.
retail investors, I would generally suggest to say slightly away from buying directly bonds in the secondary market. Of course, you can go ahead and take investment calls in corporate deposits or debt mutual funds or fixed deposits or post office schemes, depending on how do you want to structure your liquidity, core and tactical portfolio, Karthik.
Right, Keaton. So, let's stick to then the theme of debt funds only and not complicated with the bond market. Maybe, that calls for another episode. And within the debt category, also the short term and the ultra short term, I think is going to occupy a lot of time. And we're also getting some questions. So I'll request Abhishek Gupta and Abhishek Mal both to stay with us. We'll come to your questions subsequently. But before we get down to answering their questions, Keaton, I also wanted to understand that would you suggest debt funds to be only a certain part of your total portfolio? Like you mentioned, you should have some savings which you can immediately liquidate, and there should be money in the bank account, or should it form a chunk of an investor's portfolio who is risk averse?
So Karthik, in my opinion, like I said, look, there are 16 different categories in debt mutual funds, right? In my opinion, debt mutual fund can be a part of anybody who's ultra conservative to somebody who's aggressive, because there are products available or schemes available that solves each of these purposes, right? So in my opinion, if you can really understand how to select which amongst these 16 categories to form your tactical, core, or liquidity portfolio, I don't see a reason why you would want to dip outside of the mutual fund universe to build your fixed income portfolio. But having said that, look, this is only meant for somebody who understands or is guided by somebody who understands how to build these three buckets. But for a general retail investor, my simple understanding is try and divide your investments in, let's say, bank fixed deposit, corporate fixed deposit, portfolios, debt mutual funds, right? So that you have a good diversity of investment opportunities in your portfolio. But to answer your question in one line, let's say if it is me wanting to build a debt portfolio, because I would like to believe I understand how debt mutual
You are
funds.
an expert, so let's not talk about you, Keaton. You're an expert. You're the wizard here. So talk about somebody like me. I mean, if I have my life savings in a fixed deposit and it's not beating inflation, what do I do with it?
I think it calls for a larger allocation to debt mutual funds.
Right.
And
Right.
you can do that by investing simply in funds like money market funds or short term debt funds. Even if you keep taking your exposure to these two categories that I spoke of and keep your time horizon as 3 year, 4 year, 5 year, like you would do in a bank fixed deposit or a corporate deposit, I think you will very easily be able to beat inflation and be able to generate much decent returns post tax versus, kind of allocating large chunk of your investment in a bank fixed deposit, Karthik.
Right, sure. And what about the retired folks? Would you suggest dipping into because there are risks involved and there are capital market risks involved in the debt mutual funds market? Would you suggest the retired folks also whose FDs are maturing right now to park part of that money into these debt mutual funds?
So, Karthik, what happens in the retired space, in my opinion, is there are not a lot of options available. What do I mean by that is, look, while you look at the post office scheme, which is the senior citizen scheme, you have a limit up to 15 lakh rupees that you can invest. Then you have another LIC PMVVY Yojana, which offers you close to 7.2, 7.4% kind of return. Again, that has a limit of maximum amount of money that you can really invest. So
Right.
if you are a senior citizen which has or who has less than 30 lakhs of investments to do, I think the LIC PMVVY or probably a post office or a combination of that should solve your problem to a greater extent, because you don't want to end up taking a lot of risk. But if you have a larger corpus to invest, in that case, once you occupy or consume the limits here, then definitely there is a huge opportunity or possibility that you should look at these other alternative investments available. And in my opinion, debt mutual fund definitely plays a large role here, because you can use something called a systematic withdrawal plan by
Sure.
investing your money in a debt mutual fund, so that you can keep receiving money every month or every quarter or whichever way you would want to position this as.
Right.
And that can also solve your problem of cash flows that you would want. So yes, up to 30 lakhs, you have LIC and probably a post office scheme that you can deploy your cash in. You don't have to look outside of that. But if you have a larger corpus, I think that mutual fund definitely fits the bill.
Right. So let's move away from the retired folks and come back to people like you and me, more like me, less than you, less like you. But just to sort of understand, right now we are in a low interest rate regime, and hence the debt mutual funds also, because they are investing in the bond market, are performing better. Would tables turn if the interest rates were to go up, or conversely, if the inflation was to come down? In that environment, what would you suggest in a discussion like this, like we're having today?
So, Karthik, look, our opinion definitely is that interest rates in India have bottomed out. I don't see a reason why interest rates would drastically fall from here. Now, if
So,
interest rates are supposed to go up, this is a catch-22 situation for both fixed income as well as debt mutual funds. And why do I say that? So, if you invest in a fixed deposit right now and lock yourself in for a 3-year, 5-year, like I explained to you, you will get stuck with today's lower interest rate for 3-year, 5-year, even when interest rates are going up. Right? So,
right.
that's the problem with a fixed deposit. A similar problem is with debt mutual funds. Now, what happens is when you invest in debt mutual funds, let's say theoretically, because we want to keep this simple, debt mutual fund has further invested in fixed deposits, which are also paying 6%. Now, if interest rates go up, right, debt mutual funds also face the same challenge, right, which is that they've locked themselves in at 6%, but interest rates are moving up, and hence they are also going to see a small dip in NAVs, right, because interest rates and bond values are inversely proportional, like I explained to you. But like I said, there are 16 different categories, Karthik. If you keep yourself invested at the lower end of the curve, by that I mean in, let's say, a liquid fund, ultra short term fund, low duration fund, money market funds, or probably a short term fund, what happens is the invested money comes back very quickly to the mutual fund because they've invested for 3 months, 6 months. And while they try and do reinvestment, that reinvestment can happen at the higher interest rates. So in my opinion, if you want to position yourself in debt mutual fund space right now, look at
Yeah.
investing in the lower modified duration fund category. I don't want to complicate, but try and look at funds like money market funds, or look at short-term debt funds or low duration funds, and keep your time horizon for 2-3 years. I think you will be in a better situation post-tax versus doing a 3-year fixed deposit today, Karthik.
Got it. Right. So let's take some audience questions now. There's a question coming in from Abhishek Gupta. And Abhishek Gupta wants to ask you, Kirtan, I think it's an asset allocation question where he's talking about investing both in debt and equity. That can he keep his debt portfolio limited to PPF, NPS, and fixed deposits and invest only in equity mutual funds? Is that a good strategy to follow?
Absolutely. Look, what happens over here is PPF, NPS are undoubtedly very superior products when it comes to debt allocation, in my opinion. But like I said, again, the challenge, Abhishek, here is that in PPF, you can't do more than 1.5 lakh. In NPS, you can't do more than 50 in a year. So if you have a larger corpus, then you definitely have to look outside of PPFs and the NPFs of the world, where I think a debt mutual fund plays a much better role than a fixed deposit. So if you have up to 2 lakhs that you want to deploy in a year in a fixed income asset, please stick to your PPFs and the NPFs. But if you have larger than 2 lakh rupees to deploy on the fixed income space, then outside of that versus an FD, I would think a debt mutual fund will play a better role.
Right. So, Abhishek Gupta, I hope that answers your question. Kirtan is very clear. Go ahead and invest a part of your corpus in debt mutual funds as well. Let's take a question also from another Abhishek Mal this time. Abhishek Mal wants to know what is your opinion on 5-year fixed deposits for tax purposes of ATC. I think that's a valid question because the tax calculation then sort of reduces the margin a little bit in favor of debt funds.
So Karthik, my answer to that question is first, look, you should not do investing because you want to save tax. Saving tax is incidental to investing, right? So let's say still the opportunity here is that I am investing because I want to save tax. I think there are multiple other options that you can look at, right? Let's say you can look at investing in something called as ELSS in the mutual fund space. You can look at investing probably in a PPF, which will also save your tax. Again, so if you want to look at saving tax, then I think a PPF or an ELSS mutual fund is a far superior option than doing a 5-year fixed deposit at this point in time, right? So in my opinion, tax saving and investing are two separate things. Look at them separately. If you want to do tax investing, PPF and ELSS may be a better opportunity. If you're looking at fixed income and tax together, PPF may be a better opportunity. Of course, the shortfall in PPF then is that your investment horizon is 15 years and not 5 years. And if you are able to compromise on that, yes, go ahead and choose either of them. But again, like I said, tax investing, my better opportunity is an ELSS fund than doing a 5-year fixed deposit. But if you're okay with putting in that longer time frame, then PPF turns out to be a better opportunity in the fixed income space.
Right. So, Kirtan, ELSS again goes in the equity side of scheme. So, I think Abhishek's question here was specific to a better fixed income product. So, with that in mind, how does the tax calculation change over a 5-year tax saving instrument? Is your calculation the figures that you had quoted earlier of 4.2% and 5.6% respectively, with the same assumption of 6% interest rate and 6% interest rate and 4% inflation? How does the tax calculation change then over a 5-year horizon?
So Karthik, over here, there is absolutely no change in the way I explained versus what Abhishek is trying to ask. So while you invest in a 5-year fixed deposit, you get 1,50,000 or up to 1,50,000 of tax deduction, right?
Right.
That only gives you tax deduction for this particular year that you've made your investment. It by no means that your interest that you are earning on the fixed deposit is tax-free. It is still taxable. It is still taxable. So you are still going to end up making 4.2 each year because you are in the 30% tax bracket, right? Like we explained the last time. So
right.
Which
and
is
you continue paying taxes on that once your fixed deposit matures.
Correct. Absolutely. So you will either end up paying the TDS, and then while you are finding the tax return, pay the additional tax that you have to pay as per your tax slabs, right? But this does not solve or make the returns tax-free in a 5-year fixed deposit. It only solves the problem of you getting the ATC deductions initially and locking your investments for 5 years at the today lower interest rates.
Got it. Right. So, Abhishek, don't go for the 5-year fixed deposit. Don't get lured by the fact that it's going to help you save tax on interest. That is not the case. Instead, consider an instrument like the ELSs that Kirtan just suggested. Let's take one more question, Kirtan, if you're up to it. This is coming from Karan Jain. We've already partly discussed this, and he's talking about the RBI increasing interest rate. I think he means in case the RBI increases interest rate. So then, is it right to invest in debt fund, or and if that is the case, then in which fund and how much? I think it depends completely on goals and aspirations and asset allocation. But is there a rule of thumb that you can share?
So Karthik, look, there is no rule of thumb that I can really use to answer this question. But to link to what Karan is trying to ask with respect to rise in interest rates, we've already understood that when interest rates go up, your existing fixed income product may not perform well because you will still keep receiving those lower interest rates while interest rates in the markets are rising. So it's not a good sign. So typically what you do in such an interest rate situation or scenario is you try and keep your maturities lower, right? Instead of locking yourself in for 5 years, you try and invest in products which are 3 months, 6 months, 9 months, or 1 year kind of maturity. Why? Is because when you invest in a 6-month product, it matures after 6 months. And if interest rates have gone up, then you can reinvest at a higher rate. Or if you've invested for 1 year, after 1 year, when the money comes in and interest rates have gone up, you reinvest at a higher rate. So the only thing that you can do right now when interest rates are expected to go up is keep your maturities lower, right? Because the lower you keep your maturities, you will get an opportunity to reinvest it at a higher interest rates, right? Which is why I said that while you are looking at mutual funds, look at funds which have lower maturities, which are typically the ultra short-term bond funds or the low duration funds or the money market funds, right? These are the funds which will be able to tap into the rising interest rate environment pretty quickly which your fixed deposit otherwise will not be able to, is because you've locked yourself in for 3 months, 3 years or 6 years.
Right. Let's take one more question, and this one is coming in from Kedar Dave. Kedar wants to know how to manage the risk of loan default in a debt mutual fund, like the current Franklin debt mutual fund problem. Can investors do anything about managing a risk like that, Ketan?
Karthik, look, over the last 20, 25 years that the industry has been functioning, this is one of the cases that have happened. And I would, because I kind of slightly understand this market, I would not really suggest that investors extrapolate this one situation saying that this is how it typically behaves, right? This is a very one-off situation, and I don't see something like this happening too often. Or rather, I don't see a reason why you will see something like this happening over the next half a decade or 1 decade. Having said that, look, at your end, as an investor, there is very little that you can do to be in a position to predict if something like this is going to happen or not. But I can give you a rule of thumb. The rule of thumb is that while you invest in debt mutual funds give out a fact sheet every month to you. In the fact sheet, you will see something called as CBLO, or you will see something called as TREPS. Now, I don't want to go into the details, but you will see this at the very fag end of the portfolio. I repeat, CBLO or TREPS. Whenever you see CBLO or TREPS there above -10, so you see that number as -12, -15, -18, that can be a sign that there is something going wrong in the debt mutual fund space, or there is some very disturbing thing going on that you are not able to figure out, because it should not be -10 and above, right? That is one time, if you don't want to take risk, remove your monies out, right? Because had you done the same analysis on the Franklin Templeton funds that went into limbo, that happened, with this simple analysis, you could have been in a position to figure out what went wrong with Franklin much before things went wrong with Franklin. So if you really want to be in a position to predict something like this, CBLO, TREPS, something like this that you see on the fact sheet, if you see that number above 10%, right, don't try and risk your money, get out. But I don't think you will be able to spot something like this very soon.
Right. I think that's a very interesting subject you've raised and given us an idea. And Kirtan, I request you to write a piece for us at Money9 to explain what these two terms that you mentioned, CBLO and TREPS, what they stand for, how should an investor go about looking at it, and what that number of -10 or above denotes. I think that's going to be of great help to our viewers. Before I let you go, one last question, if you're up to it, Kirtan.
Sure.
And this one is coming from Siddhartha. And he wants to know, well, it's a very, very goal-linked question. He wants to know if I want to upgrade my gaming setup for about 1 lakh before the year end. I think he's talking about the calendar year, not the financial year. Where should I park my money for this goal?
So, because we are already in May, and probably if we are looking at it in terms of calendar year, we have some 6-7 months left. So the right fit for this particular investment will be an ultra short-term fund, is because ultra short-term funds typically have 3 to 6 months of maturities that they invest in. So assuming on the highest side that ultra short-term funds would have invested in 6 months maturity, that syncs exactly with respect to Siddhartha's goal. And I think ultra short-term fund may end up being the best proposition for Siddhartha.
Right, Siddharth. So go in for the ultra short fund, and once your new gaming set is in, and hopefully by then, if the situation with the pandemic is better, do invite us also for a game or two. I think let's move on to one final question, Kirtan. Sorry, I think we've exceeded our time limit, but a lot of questions coming in, and this one is again from Abhishek Gupta, and he wants to know, how do I get committed to form an emergency fund? I'm a salaried individual, and the moment I see my money in my saving bank account, I think of investing it. What should be the corpus of the emergency fund? And I think he also wants to understand where should he invest to build that emergency fund. So let's just spend a minute or two on emergency fund and then call it a wrap.
So Abhishek, look, in my opinion, while you are trying to build emergency fund, the first thing that you really want to ignore is what returns are you going to make on it, right? don't try and tap into trying to make better returns on your emergency fund, because that does not sink in well with respect to the goal, which is emergency. In my opinion, look, the thumb rule that I typically suggest to the investors that I deal with is you should have anywhere in the range of 6 months to 12 months of your monthly expenses, including your EMIs, made available in your emergency corpus. So at any point in time, sometimes you lose your job or whatever happens, for which you need a cash flow. You should at least have 6 months to 12 months of cash flow available, so that your household expenses are not at stake, for which you start taking stress. So try and make sure that 6 to 12 months of your either income, or in the worst case, your household expenses, including your EMIs, are made available in the emergency fund. An emergency fund can either be savings account, can be a liquid fund, or I've seen a lot of people even put that in arbitrage fund. I would be very comfortable doing either of these three, because objective here is not to try and generate higher returns, but to make sure that the funds are available whenever I immediately want it. So liquid fund is my top bet. So either liquid or savings account, because you have so many banks or non-banking finance companies, rather not non-banking, but you have so many banks or small banks offering you as high as 5.5-6% on savings account also, which I don't think a liquid fund will really be able to match currently. But I don't want to contradict myself, because I just said that you should not look at returns while you are doing emergency fund saving. I think a
But a
savings
little
bank.
bit of return will not hurt. If you get a little bit of return along with creating an emergency fund, it's sure not going to hurt.
Yeah, so yeah, of course, which is why I made that comment. But I think a liquid fund or a savings bank account, or probably even in some cases an arbitrage fund, either of the three should be good, provided 6 to 12 months of your expenses slash income, whichever you are able to manage, should definitely be made available in the emergency fund.
Right. I think that answers a lot of questions and a lot of queries. Thank you so much, Kirtan Shah, for sparing time and being here with us. I'm sure this masterclass has a lot of takeaways and people will want to come back and look at this interview over and over again. Thank you so much, Kirtan Shah. Pleasure having you on Money 9.
Thank you so much for inviting me, Karthik.
Well, that's a wrap on this Money Masterclass. Do visit our website, www.money9.com, for all news and updates on personal finance. This is Karthik Malhotra signing off. Goodbye.